Hello and welcome to the fourth of our ACCA F5 lecture recaps. This one was on throughput accounting. So the first thing we need to realize about throughput accounting is that it's applicable to a just-in-time environment. But what is that? Well, the traditional view, first of all, it said that you had valuable equipment, i.e. machinery, and you shouldn't leave that valuable equipment idle. Okay, you shouldn't have idle time, so you should just keep producing, and then if you make excess inventory, you should store that. Store the excess inventory. It's an asset anyway. It can sit on your balance sheet until you can sell it, and you'll store it until then. So large batches were seen to be efficient. So producing large batches, keeping your machinery running, was seen to be efficient. You then had to balance the holding costs of the inventory. The modern view, however, takes a bit of a different scope on this. They say that inventory ties up cash. Okay, inventory is a debit on your balance sheet. It's an asset, but it ties up cash. So you've had to spend the cash on actually producing that inventory. So you don't want to have large amounts of inventory tying up your cash. You want a smooth, steady flow through your production line. Okay, a smooth, steady flow of products, so that inventory doesn't build up at different processes throughout your line. You're looking now for variety, not volume. So think back to ABC, and we talked about how production has now changed. People want a variety of products. They're not just interested in the same product. They want a variety, not the volume, but the variety of products. So just in time seeks to solve some of those issues. It's a pull system. What do I mean by a pull system? Well, it's demand led. So basically you don't produce unless there's demand for the product. Okay, we think of Nissan cars. They don't produce a car unless that car has been ordered. Okay, so a pull system means that it's demand led, so you don't produce unless it has been ordered. Inventory is bad, so we seek to minimize inventory throughout the system, minimize inventory at each level, at the start, the middle and the end of the processes. So you don't have a build-up of raw materials at the start or through the system. You order the raw materials when needed, which means you need a reliable supplier and you need quality from your supplier. When you're in the system, you're going to have low inventory. If you've got several processes to go through, you don't want inventory building up before each process. So you focus on making that process as efficient as possible to get the thing moving through. Okay, so throughput is based on the theory of constraints. The theory of constraints is that there are factors which constrain production. Okay, these are called bottlenecks, things that are making production less than it could be. So what management should do is focus on these factors. They need to remove the bottlenecks, and that will speed up production and increase your throughput. So if you look at this little example, we have process A, B and C. A can produce 1,000 units per hour, B 750 units per hour and C 1,000 units per hour. So the factor constraining production here is process B, because no matter how many units go into it, so there's 1,000 coming out of A into B, it can only produce 750. So although C could produce 1,000, B can only give it 750 per hour, and therefore the maximum that the whole system can produce is 750 per hour. So process B is the bottleneck. So get used to identifying what the bottleneck process is. Throughput contribution then. Well, when we're talking about marginal costing, we said that our contribution is sales less direct material, direct labour and direct overheads, i.e. sales less variable costs. With throughput contribution, it's sales less direct materials. It assumes that your direct labour and your direct overhead are fixed in the short term. So we're looking at the very short term on this. The reason for that is if you think of labour, labour will often be on a minimum of a 3-month contract. So in the very short term, labour is a fixed cost. You can't just tell your workers to go home that day. Same with overheads. They'll be fixed in the very short term. So throughput contribution is sales less direct materials. So the concepts to bear in mind as we run through the calculations for throughput. All costs are fixed in the short term except materials. That's why our throughput contribution is sales less direct materials. Inventory is bad, so we don't want inventory building up through the system. We want a smooth, steady flow with all of the processes able to produce the same amount. Sales equal profit. Now sales equal profit because the system is demand led. You're only going to produce if the product is demanded, and you're only going to produce if it's profitable to do so. Okay, so therefore there's always a sale at the end of the process because you're only producing whenever it's being demanded. So as long as that sale is making a margin or a profit, then all of your sales equal profit. So you want to focus on getting as much through the factory as possible, because the more you can get through the factory, the more profit you can make. So that's the key as well. No demand equals no production. So you want to focus on getting throughput through the factory as quickly as possible. So the calculations on throughput accounting. Well, the first one was our throughput contribution. We know how to do that. Sales less direct materials. This really wants to check, are we covering our materials cost? We then need to make that into a return per factory hour, and all that is your throughput contribution per factory hour. And we'll look at the bottleneck for that. Okay, so how many throughput contribution, or how much throughput contribution in 1 hour of production using the bottleneck for your hours of production. So see how many hours the bottleneck runs for, how much throughput contribution can we do in that amount of time. The throughput accounting ratio then, well, what it wants to tell us is, are we making a profit? So throughput accounting ratio tells us, are we making a profit? And what it is the return per factory hour, i.e. the throughput contribution per factory hour, over all the other factory costs per hour. Okay, so you'll be given the other factory costs in the question. The return per factory hour over the other factory costs per hour will tell you if you're making a profit. So the result of your throughput accounting ratio will be around 1. So if it's greater than 1, that means you're making a profit. If it's less than 1, you're making a loss. So if you think about this little calculation here, the return per factory hour will be your throughput contribution. So if that is greater than all of the other factory costs, that will give you a throughput accounting ratio greater than 1, i.e. you're making a profit. And that's all the throughput accounting ratio is trying to tell you. So the result is greater than 1, you get a profit, less than 1, you make a loss. Ways to improve your throughput accounting ratio? Well, you could increase your selling price, you could reduce your material costs, you could improve the bottleneck, so improve efficiency so that you get more, or you run it for more hours and get more out. Or you could increase your capital investment to increase the efficiency again of your bottleneck. Lastly, you could reduce those fixed costs, so all of those other factory costs, if you reduce those and you're making the same throughput contribution, that will increase your throughput accounting ratio. When you're looking at a question that says, should you cease production given that your throughput accounting ratio is maybe less than 1, well, you need to consider another few factors. You need to think about the long-term impact of ceasing production. You need to think about consumer perception. Will they see this as a business that's, maybe going under? You need to think about related sales. Are there related sales? You'll often be given more than one product. So will the sales on the other products be hit as a result of ceasing production on one of the products? And lastly, you're going to have excess capacity. If you cease production on one product, you'll have excess capacity. What are you going to do with that excess capacity? You need to think about what you'll do with that. Okay, so that was our session on throughput accounting.